Good morning, Olivia.
Morning, James.
Thank you very much for doing this. Apologies that we're slightly later than expected. We might run on slightly longer, but we'll make sure you get your time to tell us all about the fund and what you're trying to do with it, please. So actually, I'm going to hand over to you for a while, just to let you sort of talk to us about the story, please.
Lovely. Well, thank you for having me. And I'm really delighted to be here to talk about Majedie Investments PLC. It's been a time of change for the trust. So let me start with a bit of context before sharing some colour on our investment approach and then turning to some key features of the trust. So we can flip forward one slide for me, please, James. So Majedie's origins lie in the early 20th century, specifically 1910. Sorry, back one. Thank you. And really, since 1910, the goal has been consistent to grow and preserve generational wealth in a responsible manner, initially specifically for the Barlow family. In 1985, Majedie became an investment trust. And if we fast forward to the present day, following the sale of Majedie Asset Management to Lion Trust, the board wanted a fresh approach, so they went out to tender. Let's move forward a slide and see what they were looking for. Their focus remained on real wealth creation, in other words, inflation-beating returns, and they wanted equities to remain at the heart of the approach. But they were seeking something differentiated and idiosyncratic, something a bit different to what you could access through UCITS formats. They wanted experience, both with managing inflation plus mandates and with the investment trust format, and they wanted strong alignment with the manager regarding both financial success and culture. So following their review, we were pleased to be selected as the new manager and assumed responsibility for the trust following the January 2023 AGM. If we go forward one slide, and I'll introduce you to Marylebone Partners. We were founded over 10 years ago by our Chief Investment Officer, Dan Higgins, and have a long history managing money with a view to delivering inflation-beating returns for endowments, families, and high net worth individuals. Dan and I lead an experienced investment team supported by an excellent investment committee and equally experienced colleagues on the operational and client side. To give you a sense of our backgrounds, Dan was previously the Chief Investment Officer at Fauchier Partners, a leading London-based fund of funds where, amongst his responsibilities, he ran their investment trust. And I joined Marylebone 7 years ago from the Wellcome Trust, the largest endowment in the UK. So let's move forward a slide and talk about our liquid endowment approach. Flip forward one more, thank you. This is built on the successful philosophy of the big US endowments to be long-term, fundamental, and focused on differentiated sources of returns. But we focus solely on the liquid markets. So we have no private equity, no venture capital, no property, and no infrastructure. We see plenty of opportunity in the liquid markets where pricing is more transparent and there's greater clarity around exit. And we manage with a real, i.e. above inflation return objective, 4% above UK CPI over rolling 5-year periods. And that includes a 3% a year dividend on NAV. This is what we've always done for over 10 years at Marylebone and also at our prior firms. But we also feel it suits the current investment environment well, where rates are structurally higher, macro and geopolitics are volatile, and there may be significant divergence in the fortunes of winners and losers. So let's move forward a slide and talk about how we do it. We've got 3 building blocks: direct investments, which are around a quarter of the portfolio today, external managers at just over half of the portfolio, and special investments, which are on their way to 15% of the portfolio and should rise further over time towards our near-term target of around 20%. We combine these 3 elements into a portfolio of differentiated ideas. We want to capture their return potential, so we manage a high conviction, relatively concentrated portfolio. But because the different elements are quite different to each other, their combination provides good diversification, reducing the long-term risk of permanent capital loss. So let's move on to direct investments. What are these? They're primarily listed equities picked in-house. They're fundamental, long-term positions with a quality overlay. We manage with a broad mandate, so we need to be very focused on how we do it with an intensity we feel is necessary. We run the sorts of screens you might expect, focused on growth, margins, and returns. but many of our best investments in the past have been in companies that are not yet filtering through on these sorts of screens, where there might be an element of change within the business, where we think the level, profitability, or quality of their growth might inflect. Often these ideas come from managers or fellow stock pickers in our network who we have known for years. And then we go deep into the company to understand its growth, profitability, business and management quality, and whether, crucially, we think there's an opportunity to buy them well. Always it's best to illustrate these sorts of things with an example. So let's take Westinghouse Air Brake Technologies Corp, or Wabtec for short. Wabtec's a leading provider of products and services to the rail industry, both freight and transit. When we first invested 3 years ago, Wabtec had been feeling a significant drag from the efficiency-driven cost-cutting programs of its end customers, but we felt the scope for that was diminishing. Indeed, we felt those same customers would soon need to step up their investment to drive the next leg of efficiency and also to decarbonise. Both of these would be driven by Wabtec's products and services. So that was the long-term view. Shorter term, we also felt that rail freight, which had been depressed through COVID, was likely to start to rebound, improving overall market health. That thesis has played out well, with Wabtec growing its revenues and earnings strongly, and the stock price responding. We continue to own the shares, including for Majedie shareholders, albeit having taken some profit. So let's move forward a slide and talk about our external managers. Here we own positions in a small number of specialist managers in areas that we consider offer persistent opportunity. Around half are equity focused and the other half are credit oriented, reflecting what we feel is a rich and complementary opportunity set in both parts of the market today. On the equity side, these are specialists with particular regions, sectors, or styles. For example, small and mid-cap biotech, activism, or Chinese equities. In credit, we've really broadened out our exposure in response to the evolving opportunity set, which I can talk through more in a moment. Across the board, what we look for are talented managers. These are often small teams operating as boutiques who are driven and aligned with our success. Many are capacity constrained and few have vehicles available to retail investors. We need to feel that their success has been and will continue to be a function of their skill. And to do that, we use both quantitative and qualitative tools, including appraising the drivers of their past returns and referencing them across our network. Once we're invested, we continue to monitor them to calibrate whether their edge and the area in which they invest remain compelling. So let's take our credit managers to give a little bit more insight here. It's a part of the portfolio that's perhaps a little less familiar to this audience, or at least the way that we do credit. At a high level, higher interest rates have significantly expanded the opportunity set relative to a few years ago. That's a good starting point, but we believe security selection is critical. You need to own the right names and avoid the wrong ones. We think strong fundamental credit analysis can enable compelling high single-digit to low double-digit returns from the performing part of the market, where companies are able to pay their coupons, but yields may have become attractive because the market fears they may not. People like Mill Street in the US and ICOS in Europe look for situations where they believe these fears are ill-founded. Some of these companies, however, cannot pay. That represents a different sort of opportunity to take the companies with good assets but bad balance sheets through restructuring. This requires a very specialist skill set. Experts like Silverpoint, who we've known and invested with for decades, do it well. We like these sorts of situations because they deliver returns with a very different pattern to equity markets. And finally, let's turn to the third element of our approach, special investments. These are opportunities to invest alongside great investors in high conviction ideas. They're typically higher risk situations, given the higher return target, but their eclectic nature means they do all feel quite different from each other and from the wider portfolio. Each of these ideas must come from a trusted source, offer 20% a year return potential, and a way to realise value within 12 to 36 months. And when we're appraising these ideas, we really combine our direct investment and manager selection skills. We look for situations where we have both very high trust in and alignment with the sponsor manager, and where the specific investment thesis is compelling. I wanted, before I give an example, to have a quick word about disclosure. Some of these situations are quite sensitive. So, for example, where we might be backing an activist campaign that's not yet publicly disclosed. And that's why we use project names in our reporting. Our goal is always to be as transparent as we can be, subject to those sensitivities. So we typically disclose the underlying investment as soon as we're able to, typically in our quarterly updates and semi-annual reports. So let's take an example, one of the first that we did for Majedie shareholders since taking over the mandate. Project Bungalow, where the underlying investment is in the shares of the restaurant operator Shake Shack. This idea was brought to us by Engaged Capital, a small and mid-cap US activist manager based in Newport Beach in the US. We've known them for many years, and in addition to being invested in their fund, have co-invested with them multiple times across a number of sectors. They have invested and driven change in the US restaurant sector in the past, and we felt that they had a strong sense not only of what it meant to operate effectively, but also of who they could call on and work with to bring that excellence to Shake Shack. Prior to their investment in early 2023, Shake Shack was already a well-loved brand with a loyal following. However, as it grew from its roots across America and indeed the world, the format started to struggle to earn the margins and returns on capital that it really should have. Engage felt that an injection of new talent at board and management level, primarily from the quick service industry, would quickly enable tangible improvements to earnings. Things like standardizing rotas and new store builds, streamlining menus, and driving more effective marketing. They worked with the company to bring in consultants and refresh the board. Progress has been promising and the stock has responded well. And if you want a little bit more detail on either Wabtec or Shake Shack, you'll find a short video on each of them on the Majedie Investments website. So let's move on to performance. It's early days, but how have we done so far? The NAV total return, so including what we've paid out in dividends, since we took over management of the mandate on the 1st of February 2023, is up around 11%, which includes a drag from the legacy Lion Trust shares, which are now sold, and the effects of a phased transition to our management. Total returns, so the share price plus dividends, since the board proposed our appointment in early November 2022, is up over 40%. In other words, the discount to NAV has closed materially, reflecting that encouraging early NAV performance and a significant change in the shareholder base. The Barlow family still own around 50% of shares, but the remainder sit across a range of groups, across wealth managers, high net worth individuals, endowments, retail platforms, and, as you might hope, us, the people managing the money. We're delighted to have seen some long-term shareholders declare material positions in the trust. Now let's turn on to some of the terms and features of the trust for those who are less familiar. We've set these out on this slide, and I won't go through each element, but rather draw your attention to two particular points. One is the OCR at around 2.5%. This level reflects the fact that we take a very active approach to managing the capital, and that does bring an additional layer of fees. It's our job to reduce these where possible, for example, by including our in-house direct equities, where there is no additional layer of fees, and negotiating low or no management fee agreements for our special investments. But where we do pay fees, we always ensure that they offer good value to investors on a net of fees basis. With respect to our own management fee, this is currently 90 basis points on market cap, ensuring alignment with the shareholder experience. And that level steps down as the trust grows. You can see the detail of that in the footnotes. The second point I wanted to draw your attention to is currency management. Our goal is not to take a view on currency, so we hedge non-sterling assets back to sterling, with the exception of the special investments. The final point I'd note is regarding the valuation of our underlying investments. Everything in the trust is marked to market, typically monthly, but at least quarterly, based on underlying securities, over 95% of which have a traded price, And just to reiterate, we don't own private investments. So in summary, just flip one more slide. Thank you, James. We believe the market environment speaks to active management, and we intend to do what we have done throughout our history. The transition to our liquid endowment model is complete, and we're now focused on finding idiosyncratic opportunities, each capable of making 8% to over 20% returns. And we'll look to blend those in a way that creates true diversification to achieve what we hope will be a high single-digit to low double-digit per annum return over rolling 5-year periods. We think that should beat inflation wherever it lands. And today we see plenty of opportunity to do that. Though we would agree that markets are generally efficient, there are always pockets of opportunity for long-term weighing machine investors like us. And we see a real breadth of such situations today. That means we don't have to embrace a single asset class or a single style or a regional bias. We can build a compelling portfolio of bottom-up ideas, each with its own return drivers. I hope that gives you a sense of who we are and what we're doing at Majedie. And James, I'll pass back to you for Q&A.
Thank you very much, Olivia. That's really helpful. So let's have a look. So this is the strategy allocation here. So we've got just a big picture thing. So what determines the split of this between the different pockets?
Sure. So everything we do is very bottom up and fundamental. So we don't kind of start with a very strict strategic asset allocation across the different buckets. But in reality, we'd expect them to fall in ranges. So I mentioned that our goal with the special investments, for example, is to take that up to 20% in the near term, and that may go higher up towards 30 if the opportunity set presents itself there. So I would think about that in the kind of 15 to 20% range in the near term, but it will be driven by the pipeline that we see, and I can come on to that if that's helpful. The external managers will always form the core of the portfolio. So typically, I think that will typically be above 50% of the portfolio. The direct investments, I think, is roughly where you should expect it to be today. Most of that is stocks, but it also does include some of our slightly more thematic exposure around clean energy transition. So our copper exposure lives there. And then the balancing item is really the cash and the gilts. We will always have a little bit of that, but right now I think we are preserving some additional flexibility so that we can respond to the market environment. Hopefully that gives a little bit of a sense.
Yeah, because that was the question I was going to come on to, is that, so what role do the gilts play? So it, as you say, it's a liquidity home, I suppose. But what do you think the outlook is for the gilt market at the moment?
So I would say we don't really have a particular outlook on the gilt market. I think the way that we've thought about gilts is that now that they do offer a reasonable yield, it presents us with a really nice tool in the portfolio. So ideally, we wouldn't be having too much cash at any point in time. And when I say cash, I include gilts in that. But the nice thing right now is that you don't need to be in a hurry to deploy. You can be responsive to the opportunities that come through. And because, we are very long term, we hope to manage this trust for many years. We've been building it up incrementally over time. And we've actually had some recycling a bit faster than we would have expected, particularly from some of those special investments, which is really why the cash is where it is. So I wouldn't say it's a kind of view on gilts per se. It's more that it's a sensible place to put your cash while you're waiting to redeploy it. And we have some other elements of the portfolio that feel somewhat similar to that. But you should expect to see us deploying that.
Okay, thank you. You mentioned copper just in passing there. What is the theory behind holding copper with it? Is it actually physical copper you're holding, or is it in the miners?
So it's in the miners, and we actually own an ETF there. We're not typically people who own ETFs, but I think in this particular case, it really suits our thesis very well. So our overall view on copper is that there's a very constructive long-term supply-demand imbalance, and that's really driven, and the most recent manager letter on the website provides a lot more color around this. But in a nutshell, it's really driven by incremental demand coming from the transition to a green economy, so electric vehicles and electrification of the grid, versus relatively constrained supply. We've got mine disruptions, decreasing ore grades, and some elements of environmental planning around that. So we feel very constructive on the long term. You might say, well, why don't you just own the copper through the commodity? And the reason that we don't do that at the core of our allocation in copper is really that we want duration on our side. We want to be, equities are great in that way. You can take a long-term view with equities. And with copper as a commodity, it's harder to do that. The copper price does get moved around quite a bit by short-term factors. And indeed, when we've been thinking about building our copper exposure, we are very cognizant that we need to be very aware of those short-term factors. So we put ourselves in the best position possible to take the long-term view. And we work with an external advisor to help us calibrate that, particularly around some of the push me, pull me from China. So that had obviously been a big drag on copper demand expectations, and it's becoming a slightly more constructive outlook there. So that's how we express our copper view. It's similar, incidentally, to how we express our uranium view. We've had a long-standing constructive stance on uranium, also through the lens of energy transition and supply-demand mismatch. And the core of that has historically also been in uranium equities rather than in sort of exposure to the spot price.
Okay, that's cool. What's been driving your returns recently? Because you're in the flexible investment sector, you are looking sort of towards the top of the pack at the moment.
Well, I'm pleased to hear that. I'm glad that people are generally constructive. So it has been a really pleasingly broad-based return sort of attribution when we break it down and we look at the various pieces. So maybe if I start with the directs portfolio, that has generally actually done a pretty good job. It's broadly kept up with the equity markets, despite looking very different to their narrow market leadership we've seen there. We have had some benefit early in our tenure as the manager from things like Adobe and Sage, so both software stocks. We've gone on to sell those because they've reached price targets, but they were a really nice contributor early doors. We've had some stock-specific successes in things like Wabtec that I mentioned, but generally quite a broad-based constructive view there. On the external managers, it's really been led by our equity-centric managers, not a huge surprise. The biggest single contributor is Helicon Investments, one of our largest manager relationships. They've really done an excellent job. Their portfolio manager there, Federico Riggio, is a really exceptional, unusual talent, I would say. It's closed to new investors, so we're delighted to have capacity there. And then outside of equities, it's been a really solid return from the credit side of the book. Which I think is actually quite really testament to their credit selection, because credit has been quite a varied area. But if I was to pull out a couple of managers there, I would say Mill Street, the US high yield focus manager I mentioned, has delivered very nicely, and Contrarian as well, which is our emerging market debt manager, which is a bit more focused on stressed and distressed situations, so does look quite different to the wider emerging market debt market. And then the copper and uranium, actually, I should say, they've had a good contribution so far.
Great. I mean, it's encouraging. I suppose the performance is coming from different parts of portfolios at the same time, which is good. There's a question here about the amount of information that you put out on the portfolio. So we haven't got a list of sort of like your biggest holdings or anything here on the slide. Is that something that you actually do publish?
We do. So we publish everything that is over a 1% position in the portfolio semi-annually. So you can find that in our March 2024 report will be the most recent one. And then in our monthly fact sheets, we put out the largest 5 holdings in each of the 3 buckets. So hopefully that gives a really nice level of colour. And as I mentioned, we're particularly cognizant that people sometimes have questions around our special investments because of these project names. We do continue to refer to those by project name in the monthly reports for consistency, so people can tie them together. But if you ever want to know what one of those are, you can refer back to the most recent semi-annual report or quarterly investment manager letter, and you will generally find what those are, unless there's a reason we can't say it. But generally, we really do want people to understand what's in the portfolio.
Cool, thank you. Dividends. What's the sort of dividend strategy on here?
Sure. So this was very much set by the board. We manage with a total return mandate, and that's always been our approach. So some of our underlying holdings are cash generative, but most of them are total return, particularly the funds. And so when we were talking with the board about what would be an appropriate level of dividend to support from the portfolio and the way we want to run it, they felt, and we agreed, that about 3% a year on NAV was very, very sustainable. We could do that very comfortably. It was previously a higher level, as you probably know, but that was with a very different strategy underpinning it.
Okay, fair enough. Now we've been backwards and forwards on cost disclosures and everything else for months now. That OCR that you've got, the 2.5%, is that including the fees on some of the underlying managers as well?
It is. So that number includes our management fees, some of the vehicle costs, and the management fees that the underlying managers charge as well. It doesn't include performance fees, which I think is standard in the sector not to include those. And it doesn't include the cost of the debenture. We can talk about the debenture separately, but obviously that's a structural feature of the trust at the moment, which comes due next year and the board are discussing.
So if we just took at the sort of the fees at the high level fees, so your fee and then the sort of running expenses of the fund, do you have any idea what the fee would be then, the OCR fee?
So I think that is the 2.5. So our fee is in there, and then the underlying fees to the managers, and then the vehicle costs. So so the only thing that we haven't included in there is the debenture.
Yeah, okay, no, that's fair enough. I understand, yeah. All right, good. There are some very specific questions about some very specific holdings. So I suppose we could have a look at. So actually, let's pick out a couple of them. So just can you tell us a little bit about the Helicon Long Short Equity Fund, please?
Of course. I mean, I'm delighted you asked that one, James. It's our top performer since we took over the trust. So whoever asked that is being very kind to me. So they are a European-focused long-short manager. They have a really eclectic group of positions that actually span equities predominantly, but also some credit. The areas that they really focus on are Southern Europe, which has a very particular pattern. And also they do have some emerging market exposure at the moment. And the sorts of situations they'll get involved in are a little racier, I suppose I would say, but they do risk manage it really quite thoughtfully. So things like they've got some gold mining exposure. They've also got some utility and bank exposure in Southern Europe. They're very good at looking at situations that feel quite value-like and really picking apart the asset or balance sheet backing of those situations. Federico, who runs the fund, is extremely high energy and has a really experienced team working with him. They worked together at their previous firm, Kairos, and span out a few years ago. So we feel really excited about them. I think we feel very fortunate we've been able to build the position we have. The fund is now closed to new investors, and we were able to invest prior to that with quite attractive terms as well. So yeah, a really great part of the equity-centric bit of the portfolio.
Cool. And then can you also talk about Paradigm Bio Capital, please?
Of course. So this is a long-short, small and mid-cap biotech manager based in New York. We started to feel much more constructive on the biotech, particularly small and mid-cap biotech space, around the middle of 2022. The sector had gone through a pretty painful drawdown, really reflecting the sucking out of liquidity from the wider markets, and to some extent, a string of quite disappointing clinical catalysts. And we wanted to find a manager that could help us kind of get invested in that space and really benefit from what we felt should be an element of recovery. But importantly, we really wanted an all-weather manager there. So a lot of our managers are actually long only, but here we think long short is particularly powerful because the reality is that despite the returns to innovation over time, most drugs that enter the clinic fail. So you need someone who's got the ability to think really big about the potential of drugs, but also be grounded in the reality that most will fail. And we think in Paradigm, we've really found that. Again, it was a relatively new manager when we backed him, but he was coming with a lot of experience. Senai Asafor is his name, and he came from a really industry-leading long-short fund called Avoro before. And again, we invested quite early with them, and I think they've been very, very thoughtful about how they've built their exposure and evolved that as the opportunity set has evolved. So we felt very good about how they protected capital through the drawdown. Most of that was prior to Majedie under our watch, but then they benefited really well in the back half of 23. Back half of 22, did a decent job last year, and then have been, a little disappointing year to date, but nothing really to write home about there. I think they're doing a good job and really what we expect of them.
That's really helpful. Thank you very much, Olivia. We covered an awful lot of ground. I think you should probably rest about there, but thanks for the information this morning. We'll obviously be keeping an eye on what's going on, and we'll get you back on again in a year or so and see what the progress has been. But
super, looking forward to it. Thank you.
Cool. So thank you, everybody. We're back next week. We're talking to Menharden, and then the week after that is our next quarterly panel show. So we're talking about discounts, and for that we've got Nick Greenwood on, and Peter Hewitt, and Ben Ritchie from Aberdeen. So it should be an interesting discussion. I think we're going to try and sort of look at what's been causing discounts and what can be done about them. And the week after that, we've got Nick Train on. So I'm going to say we've got a full list for months to come. So thanks very much for tuning in this week, and have a good weekend, and I'll see you next Friday.